All right, good evening, everyone. Welcome and thanks for taking time to join us on tonight's webinar. Special thanks to Flip Futures for organizing this event. And as was mentioned earlier, tonight is actually the second part of a two-part rubber trading webinar series. And for those who might have missed part one, it was presented by Mr. Michael Coleman. I strongly recommend that you look it up. It's an exceptional intro to rubber trading fundamentals, and you should be able to get the web link easily from Flip Futures. Okay. Now, first thing first, disclaimer as always, especially in the context of what we are presenting today. So just take a second to ponder over it. Okay, with that out, let me just give you a brief run through of my background. So I have been intimately involved in the derivative market for the last 30 years, give or take, and predominantly trading it for the last 15. Now, I'm currently a trader with SLC and also director at its Frontier Trading Solution, or short for ITS. And well, what we do at ITS is basically developing trading solutions and system. But on top of that, ITS also conducts professional trading workshops and a mentoring program. And I believe what sets ITS apart from the rest in the market is the fact that these courses are conducted and run by active traders with vast knowledge and experience with both past and present markets. So there is a little of value add in terms of the currency and the up-to-dateness of the trainer's profile. Now, additionally, our curriculum is designed rather unconventionally. Now, as we all know, the one perpetual of a market is that of change, right? Now, sadly, over time, I have witnessed quite a number of my peers actually falling off the wagon in a sense when they fail to adapt to the evolving market, which is constantly evolving. Okay, that's to say the least. Now, whatever winning formula or strategy that one can conjure up today could very easily and likely be rendered irrelevant as the market evolves and changes, and if we do not adapt accordingly. Now, so at ITS, we aim to teach our students to fish rather than give him one. Okay, so we do that by breaking down and teaching the students the process, the whole process actually of our strategy formulation from the ground up, showing them how we go from a blank sheet to our research and eventually how we formulate our strategy in the way that we can deploy in the market. So with that, we hope to nurture in the students an ability to adapt and evolve and always stay relevant as market condition changes. So that's our approach for ITS. We are doing courses like that. Now, we have done a few of these courses that I mentioned, both in Malaysia and Singapore. And I'm also proud to share that most of our students have seen a substantial improvement in their trading. Now, for those of you who are interested in what ITS has to offer, you drop me a line, and I will leave my contacts at the end of the slides. Now, okay, now with that, I believe that's all the advertisement time that I'll be getting tonight. Okay, and I will just go on to the webinar proper. And also, I will try to go a little faster on the basic stuff, which is a lot of it have been covered in detail in part one, so that I can just leave you more time for Q&A at the end. I think it's more productive and helpful that way for you too. Okay. Now, I would like to start by sharing with you that the rules that guided me over my years in trading. Now, although this may be painfully obvious for some of you, I feel these principles are what kept me alive in trading all these years. Okay. Now, the most difficult part of trading to me is actually doing it with sufficient consistency and profitability over time. Okay. So in the context of professional trading, my goal has always been to build wealth while ensuring long-term viability. Okay. In essence, I approach trading like as if I was running a business, and therefore my consideration of potential risk will always take precedence over potential profit. I'm essentially a risk-averse person in a sense, so I'll always consider risk, and I'll urge you to want to think about what I've just said here. And then the next three rules or guiding principles are fairly obvious. We always start with preservation of capital. All right. So the question is like, can we make sure that we are able to trade the next day after putting out a trade today, which may or may not turn wrong against the best of our belief or efforts? Okay, so that ensuring continuity and ability to trade again is very, very important. Okay, so size management, risk management are all not optional. It's really the first part you should consider before even touching your mouse and putting in the first trade. All right, now with that, we can go on to consistent profitability. Obviously, we are in trading for making money, to say the least. And how we approach it, either in a haphazard manner or in a more structured manner, which we do actually. What I meant is we do a lot of research, back testing, and a lot of fact finding kind of thing, and we go through a lot of historical data just to get a better understanding of what we are doing, to refine what we are really doing okay, and just so that we understand what we are doing more intimately, so that we can actually do it more efficiently. If not, we'll be able to at least sense changes to where the current strategies that we deploy are less relevant, and we know a sense of a change is coming, and we will be able to deal with it. Okay, now only after serving the first and second principles would we be able to talk about pursuing superior returns. Basically, you must make sure you'll be able to trade the next day, and that you have consistent profitability, build up some buffer before you want to talk about going to take on more risk so that you get a better returns kind of thing. All right, so to keep this short, risk management will never be an option in trading if you want to take this seriously. Okay, and to trade it professionally, please heed my words. These are really important stuff you need to consider before you start picking up the mouse. Okay, for tonight's agenda, very briefly, we'll be going through futures trading, why we trade futures, and specifically, I'll be touching on calendar spread trading of the SICOM TSR20 rubber futures. Okay, and I'll be giving you some examples as I explain some strategies that we are currently deploying in the market. Currently meaning even as of before the market closed an hour ago, I was still doing it in the same manner, or rather, it's part of what we do every day. And then finally, since we do not exist in a vacuum, I will also touch on the other rubber markets and explore with you the impact that it may have on SGX rubber prices, which is very relevant to what you're doing, even if you're not actually privy to access or have the intention to access the other markets. Okay, first off, why do we favor, or why do I favor futures trading? Now, futures is just very unique in a sense among the asset classes. All right. In short, you can see the 5 advantages that I can list up here for you. It offers leverage. It offers ease of execution. Be it you want to go long or you want to go short selling, there are very little to no restriction. And obviously, the low cost and the diversification of the types and the amount of futures have to offer is simply overwhelming. There's no shortage of futures and type of futures that you can trade, including options and stuff. And obviously, liquidity is also often very substantial. Now, consider the case of COMEX Gold. It's actually a lot beefier than the underlying market. So that can actually happen in futures market as well. Okay, so for all this, we look at futures, and by extension, we are talking about today the SICOM TSR20 calendar spread futures. Okay, now why do we do spread futures then? The same advantage that accords to you by futures trading is the same that you will see in spread trading. Spread trading essentially is a simultaneous purchase and sale of one or more offsetting futures. Now, I think most of you could relate when I say if you go to the local money changer to make a currency swap when you're going for a holiday or whatever. Well, essentially, you are trying to purchase a currency where you need in the foreign place, and in the meanwhile, you're selling the local currency which you are paying in a way for the currency that you bought. So in that essence, you have a one shot in the currency market, and that in the gist of it is basically what a spread would look like. So why do I pick this topic of spread trading? Okay, now in a spread trading, when it's likes and likes, we're talking about correlation. When we're talking about rubber futures calendar spread, you are essentially going long one rubber and short another rubber in a different expiration. So there are no product difference in sense. In a way, it will lower your risk considerably. As well, at the very least, the systematic risk is actually effectively hedged away since you're doing essentially the same product. Okay, and on top of that, in the rubber spread trading, your margin requirement compared to that of a outright rubber or any other futures is way lower, approximately about 1/3 for the case of rubber. Okay, so that offers you an even bigger leverage than what an outright could. Okay, on top of this too, you by constructing a spread in this manner and the way the market is constructed, there will be actually new ways and to take advantage of different type of trading style, be it a relative value diversion, a mean reversion strategy, seasonal trend trading, or even directional bets that can be viewed as in the sense of absolute risk lower than compared to an outright market. So all these advantages of spread trading is why I do a lot of spread trading, not just purely rubber. I've been trading rubber for the good better part of the last 3 years, and I'm still doing it these days at a very active level. And I could tell you it's something doable, and it's what I hope to share with you tonight here. Yeah. Okay. Now a few things before we go on. Let's just get the terminology out of the way. Now in SGX rubber futures trading, for example, when I talk about buying a spread, essentially what I'm saying is I'm buying the front month, the nearer month expiration, and selling a further month expiration. So for example, if I say I'm buying the May-June rubber spread, what I'm effectively trying to do here is I'm trying to buy go long the May futures and short the June futures in that way. So it matches up as a spread with a one long and one short. Okay, at the bottom of the slide, you'll be able to see the outright margin versus the calendar margin requirement there, approximately about 1/3 there, about half for this case. All right, so what are we hoping to achieve when we do a spread like that? Okay, now when you do a buy spread, you're buying the front and you're selling the back months. So essentially what you're thinking is the back months is relatively cheaper compared to the back months, and you're buying it in the hope that the front month will rise at the end of it a lot faster than the back month will. If not, the front month rise and the back month fall, even better. You're hoping for a narrowing of the spreads or the spread curve to go narrower. Okay, then you can profit and profitably exit from the position. And vice versa, if you're selling a spread, you're selling the front month and buying the further expiration month. So in that sense, you are actually gunning on the front month, dropping off at a faster pace than the back month, and and you probably can profit from it if it happens. Yeah. So that's the general idea of what a spread trading is about. Simple, isn't it? Okay. So now, with that out of the way, with so many contracts available, how do we go and pick and how do we get started in this calendar spread trading? Now, specifically for SICOM rubber trading, right? There are a total of 12 consecutive months listed in TSR20 rubber. Okay, now if you combine them together with the mix and permutation, it's a 12 factorial number. So there are hundreds of possibilities that you can actually go about trading. So you need to nitpick what is best suited to you. I will share with you how I go about the process of selecting what I like to trade among these possibilities. All right, and then run through some strategies while I'm at it. All right, so first of all, you need to know what is there. That's 12 months there, and both listed in the outright and the 1 month calendar, 2 month calendar. Okay, now then the next consideration for me will be liquidity. Why is it important? Well, can you imagine you trading something where it's so illiquid that you will have a problem getting out after you get in the position? It can happen in some of the very, very illiquid markets. So that is one position you do not want to be caught in on the opposite side, on the wrong side rather. And so liquidity becomes a primary concern when you decide whether there's something you want to do and trade, or at least for the particular expiration. Okay, now once you're done with that, then obviously you need some structured way about going about how you deploy what you believe to be true into the market. So what I'm going to talk about substantially after this slide is a mean reversion strategy. All right, it's on the premise that when market swings, or rather when a product, in this case a SICOM rubber calendar spread, has a strong mean reverting tendency. This strategy works best when the market goes to extreme and you confidently believe that the mean reversion will proceed thereafter, or will actually happen thereafter. So that is the basis of the trading angle. Okay, just a quick slide there. Ignore the rest here. Before you start trading, you need to know the specific of the contract you're trading. Obviously, that contract specs is easily available on all the major exchange websites. And you need to know one other thing is the fact that SGX rubber is a physical delivery settlement contract. What it means is if you are caught with a position on expiration, you will have to be dealing with physical delivery. Now, it's something that I will never do because I'm never in the part of the supply chain, and I have no intention of doing physical at this point of time like this. So to absolve myself from liquidity concern and physical delivery complication, I will almost always avoid the spot month, which is the current one, the nearest one to expiration. Okay, there are a few other reasons why I would do that. Okay, liquidity being one of it, and obviously this delivery pressure being the other. Okay, now if you look at the volume figure and open interest figure on SIMEX for this rubber, there's two kind of rubber actually, the RSS, which is the lesser traded one, and the more popular one that we are doing today, the TSR20 in the blue bar. Now, it's a very healthy average daily volume, about 6,000 these days, and open interest nearing 60,000 actually. So overall, if you look at those numbers alone, tells you actually this is something that's liquid and substantially so, and something that's quite tradable, even on a day-to-day basis. And then to look at the volume and open interest distribution dynamics, let's take a look at this too. And how basically it describes how there are 12 contract months, correct? So it basically describes how the volume are distributed across all these contract months. A quick look at this. Other than the spot month, which is the first month one, most of the volume would be between the 2 to the 6 contract. Okay, now this is necessarily so for one or other reasons, but need not concern yourself with this right now. Just know that for SIMEX rubber, the 3rd to the 5th month are the most active contract months. Why do I show you this slide here? Because when you are trading, not just so in terms of liquidity, you also want to have a lot of opportunity, a lot of moves, for example. When they're active, this thing tends to happen because this is where people focus most of their effort. All right, they have opposition on the buy and sell side, and people coming in to do whatever they have to do, usually in the active month, and that's what I meant. Okay, so basically on SIMEX, the 3rd and the 5th month, remember that are the active contracts that you want to actively involve yourself with. Now, the futures trading, pardon me, sorry. I wanted to talk a little bit about how the spread looks like over the course of time. So I present this chart of over a 5-year period. Now, as you can see, the rubber futures spread. Okay, I'm taking the first and the second contract. So this usually trade in a normal contango manner, meaning the back month prices are typically higher than the front month prices logically. There are very few exceptions, but there was some blips here and there when the market did trade in the backwardation. Okay, so now if you can see that in about Q2 of 2019, actually the market traded in the backwardation, and if some of you recall, that was during the period where the China-US trade tensions started flaring up, and that actually wrecked a lot of correlationship in between the asset classes. Commodities was no exception, and rubber definitely wasn't able to escape from that too. All right, so that was a small period of time where that happened, but generally speaking, as you can see, it's consistently in a steady carry market for rubber spread trading. Okay, let me just get this out of the way. All right, sorry about that. This is another chart depicting the term structure of rubber plotted on the spot price of rubber prices over time. Okay, what you see in the black line is basically a spot price of rubber, which goes up and down according to demand, supply conditions, and whatnot. The red lines are actually the spread premium or differences in the sense. Okay, now you can see from the gradient they are rather flattish, implying a very stable and coherent relationship, irregardless of where the spot and absolute market may be. So it is actually because of this fact that I'm introducing today's mean reversion strategy on rubber calendar. Okay, now this is another representation of the same that we just talked about. You could see how flattish the whole TSR20 forward curve is, and that is just the case since I started trading this 3 years ago. Okay, another representation of the same, and instead in this particular chart here, I'm showing it separately across the months. For example, the 1-2 is the first and second contract one of the rubber spread, and the 2-3, 3-4, and so on and so forth. Okay, if you can see, it's what I meant by mean reversion. It is never a one-way up trending or down market when it comes to spread for rubber, and it's almost always like a sine curve, if for lack of a better description, going up and down, or abide by different magnitude and different time and pace. Okay, now getting that out of the way, then how do we put on the trade in the rubber calendar? Okay, I will talk about 3 types of spreads tonight: the 1-month spread, the 2-month spread, and the butterfly spread, as I will demonstrate how this mean reversion strategy that I intend to talk about tonight apply to these spread markets. Okay, now as in everything that we do, we start by structurally trying to get a sense of what we do so that we can do it with any degree of confidence. Now, remember the mean reversion property that I was talking to you about earlier? Now, assuming, if you can believe me, assuming that this is true, I can tell you for a fact it's true, but prove me otherwise, prove me wrong otherwise, okay? But because of the stable term structure of rubber, okay, and the strong mean reversion property of rubber spreads, okay, what we want to do here in the mean reversion setup is we want to be long or short the spread when the spread level reaches an extreme, sort of like when the sine curve reaches a high and low of its arc. Okay, when it reaches a high, you want to sell it, and when it reaches low, you want to buy it. Why? Because you believe, for example, if this holds true, the curve eventually will revert itself into a mean value or into a center line, and that's where you can get up, or you can even ride it all the way until the next peak in the wave. Okay, so that can only be determined through study of historical data and see whether this is true and how you establish your so-called buy and sell level. All right, the upper and lower bound, the price differential, so to speak, and how we can actually put on the trades when the market is actually nearing our buy and sell level, okay, and how we unwind it when it's coming back. So let me show you the next chart. This is a 5-minute price chart of 1-month calendar spread. Now, as you can see, even in the 5-minute chart, there are plenty of ups and down. Okay. Now, I won't comment on whether it's practical to do it this way because we may each have a different risk profile, preference, and whatnot. But I will just show you what is possible. Okay. So within this line, within this 2 red line, for example, marks the visual upper and lower bound of this particular spread. So what it says is basically if you are trading it this spread and you're doing it in this interval, for example, and it hits the lower bound of the red line, this is where you want to starting to put in your bids and buy the market, hoping to unwind it when it hits the upper bound of the red line. Okay. Now this is a daily chart of the same, although it's a different spread. It's a 1-month spread though, and you can see the same tendency. But when you expand it to a daily chart, for example, you get a bigger range. Okay, but essentially the principle applies. Okay, you mark the upper and lower bound. Now these are very casual marking of bounds by visual aids. Okay, so what you need to do is use whatever technical tools that you're most comfortable with. But since this is statistical, I recommend Bollinger Band, for example. Okay, and then you can mark off the high and low end of a potential range for this spread, for example, and then decide when you want to actually get in long or get in short, for example, and then hope for the thing to reverse itself. This is the 1-month calendar spread. Okay. And to show you another way, this is a 3rd and 4th month spread. It's still a 1 month spread. I did it over a 1 year time frame. As you can see now visually, the spread mostly swings between minus 1.5 to about minus 0.7 there about, right? And if you look at the histogram here, you can see there's a strong concentration of trades, or rather tendency for it to revert to mean. That's what I meant here. So in that sense, when it actually hits nearing to negative 1.6 or whatever, I would definitely want to be a long buyer in this particular spread, and vice versa. If it hits up to like minus 8, minus 7, for example, I'll be preparing to short this in the hope that it will return back to, say, around the mean of about minus 1, minus 1.2 kind of thing. All right. Okay, this is how it looks like on a trading platform known as the Trading Technologies, is what I'm using. These are the exchange listed 1 month calendar spread. Or what I meant by exchange listed 1 month calendar spread, there's basically this product that you can go and trade, which is a calendar itself. You see, a calendar is made up of 2 legs, right? You don't really have to go and buy one while you sell the other simultaneously on 2 different like windows or ladders or whatever to make up a spread. The spread itself is offered in this manner. So as you can see, there are sufficient depth and volume in this type of spread for you to be able to do something about it. All right. Okay, the next type of spread is the 2 month spread. What is meant by a, oh sorry, I did not give you what I meant by a 1 month spread earlier. Okay, a 1 month spread in my way of putting it is like a spread that is a consecutive months. Meaning if you are doing a 2-3 spread, you're doing a February, March spread, that's a 1 month spread. You're doing a 5-6, which is a May, June spread, that is also a 1 month spread. Now, versus a 2 month spread, what happens is that 2 months in between the spread, that's all to it. There's like a 1-3 or the 5-7 or the 4-6. How is it different from the 1 month spread? Well, essentially no difference in the basis of it. But as you stretch the duration or the expiration difference between the 2 contracts, what you're introducing here essentially is more unknown and more volatility into the spread, meaning you will get a bigger range possibly and greater risk of trading it. Okay, now as usual, I start with the 5 minutes chart here for this 2 month spread. Okay, and if you can see the range clearly, I apologize, it's kind of small. It's actually a lot bigger than the 1 month spread. That is just a feature of what it is. All right. Now, if you look at the daily chart, which I plot over here, this is essentially the same thing too, except in a wider range. Now, you look at it. The same thing, not the same thing, the 3rd and the 5th. Earlier we were looking at the 3rd and the 4th 1 month spread. Now we're looking at the 3rd and the 5th 2 month spread. We have a range of minus 2.9 to minus 1.8, a full 11 points in this case. Okay, by 11 points I mean 11 ticks, since this is rubber and we trade 0.1, which represents 1 tick. But despite the minor difference, you could actually see that the mean reversion tendency and the concentration of trades around the mean is substantially evident of what we were talking about earlier. Right? That means there is a chance, or not there is a chance, there is a high tendency for this trade to revert itself once it reaches an extreme. Okay, and this is the 2 month calendar spread daily chart now versus 5 minutes earlier, and you can see we still draw the same 2 lines, except now in this case the 2 lines are wider apart, necessarily because of the way the spread trade, the higher wharf and everything. So the same principle applies. You plot your lines and you set your markers. You go in to buy when the market approaches. You buy line on the downside, and you try to get up when it hits the middle, or you could even go short it if it hits the upper bound of your line, for example. Okay, and again, the 2 month calendar spread is also listed on the exchange. Okay, and the same thing, you could actually look at it and trade it against a few other things, which I'll elaborate later. Okay, now you look at it, one thing you'll notice is actually a lot lighter in terms of depth and orders being presented there in the 2 month spread, because it's a lot volatile. So meaning to say there are a lot less people who are willing to put it out there to risk. Okay, so essentially it's tradable. All right, it really depends on what is happening on the other markets as well. All right, so for example, you're looking at this here, you got a May, June, the June, August, July, September, and even though these are the 2-month slightly extended spread, right? You could see the bid ask is still pretty tight and very, very tradable too. I trade a lot of this actually. And finally, I'd like to talk about butterfly spread. Now, when we talk about spread earlier, is a single futures contract against another in the same calendar spectrum with different expiration dates. Okay, in a butterfly spread, essentially what you're doing is a spread. You're long a whole spread against shorting another spread. So there are 4 months involved. For example, if you look at here, when we talk about the 3-4-5 butterfly spread and we're buying it, we're essentially buying the 3-4 spread and selling the 4-5 spreads. Okay, why do we do this? Okay, the same feature that extends to the 1-month, 2-month calendar spread, the same mean reverting tendency and properties of those will be seen in the butterfly spread to a more pronounced extent. What I mean is it is a lot stronger in terms of mean reversion property. Only problem with this spread is this, because there are 4 legs involved, essentially the cost of doing this spread is double that of a single 1-month or 2-month spread. That's one. And two, because of the very low vol for this kind of a spread, the way it's constructed, there will be a lot less opportunity when compared to the 1 or 2-month calendar spread trade type. Okay, but when it does present itself, it's a very lucrative contract to trade actually and to look at. So you definitely want to put this on your radar and trade alongside with your 1 or 2-month calendar spreads. Okay, now this chart basically depicts the same thing, the mean reversion properties of this particular type of spread. Okay, now everything is the same except the range for the bound is a lot narrower. Okay, like I explained, because of the way it's constructed, you're doing a spread against a spread instead of a futures against a futures. You lower the volatility substantially. Now, while the cost is higher, if that opportunity presents itself, it's actually a pretty good trade to get into. Okay, now we have talked about the mean reversion trading on calendar and butterfly spreads. The next thing I want to talk about and touch on is what I call synthetics. Well, it's not a term coined by me anyway. Synthetics is just, in English, what it just literally means made up. You realize whatever spread that we are doing here, be it the 1-month spread, 2-month spread, or even the butterfly spreads, they are essentially made up of individual contract months in the rubber spectrum. Say, for example, the 1-month, the 2-3 calendar spread. All right. So if you're long that, you're essentially long a February and short a Marches. Now, instead of going into the market and do the listed 2-3 spread, calendar spread, you could also consider doing, for example, if you wanted to long the spread, going into the outright markets. In February, for example, you place a bid, and in the Marches, you place an offer. Now, why do you want to do that? It seems like redundant and a lot of work, not to mention the risk of potentially missing a trade, so to speak. Well, when we do that, we actually give our chance an opportunity actually to explore a better, or rather a more efficient way of executing it for a slight advantage or slight edge over what the listed calendar spread has to offer. Now, if you were buying the bid, if you were able to buy the bid in the 2 and sell the offer in the 3, essentially you're doing 2 ticks better, or rather, yeah, in this case, you're essentially doing 2 ticks better than what you otherwise could have done in the listed calendar spread. Okay, now the trouble with this is obviously you need to do this. For me, I don't do it manually. Of course, the system was advanced enough to be able to let me do this, and I have developed certain algos that are able to enable me to do this efficiently. Okay, but why did I mention this at this point in time is that I want you to know when you do calendar spreads, if as I advocate, know that these are made up of the individual contract months and they don't exist in isolation. Okay, now since they are made up of the same thing, you could safely assume that the price have to be somewhat connected. It cannot be so far off in February outright and March outright that the calendar did nothing. Because if that were the case, all the arbitrages would jump in. For example, if February was too low relative to March when we consider the spread, well, what can we do? We can buy the February and sell the March outright. right? And then we go and sell the listed calendar spread for free money. Okay, so now that kind of thing still happens, but not often these days. And I didn't actually mention this so that you can try to do this, because the fact is this: there are a lot of arbitrages and HFT out there that are way faster than most people can do this, or at least faster than you and I can, even though I'm already using a computerized system and automated trading in a lot of areas. Okay, so what I wanted you to know is when, for example, you are trying to put out a position in, be it the 1 month or the 2 month calendar spread or even the butterfly spread, consider where the rest of the markets are. Okay, then you synthetically construct and know what the prices is available are available, and then you can perhaps position yourself better in terms of efficiency of execution. Okay, that's the gist of why I bring this up at this time. Okay, now with that, I will close this part of calendar trading and synthetic calendar as well. And then what I want to bring up next is the other rubber exchanges. Now, we don't exist in isolation. Myself, I do not do arbitrage between the various exchanges, predominantly because of physical consideration or logistical and infrastructure consideration, that I'm just not in the whole value chain, and therefore it's actually at this point not feasible for me to get involved in this type of trading because of the type of risk that it presents. Okay, but that does not mean I do not look at the other markets. Okay, well, one of the most active market obviously in rubber is in Shanghai. You got the RSS in the Shanghai Exchange, and the more recent TSR20 on the INE, and versus the RSS in TOCOM as well. How and why do this affect us on SIMEX when we are trading solely on SIMEX? Well, this market does not also, exist in isolation. Say, for example, a very quick one actually, in Shanghai Exchange, let's say for some reason somebody is trying to do a particular month because he needs to get in or get out vis-a-vis that particular month, month of expiration. So let's say that month is like May, for example, and he needs to sell a lot of May contracts in Shanghai. So while he's doing that, there are other people who are actively doing ups. So they are at the receiving end of this seller. So when they are long the 5th month, or rather the May contract in Shanghai, for example, they need to think about what or where can they hedge it. Well, TOCOM is one, okay? SIMEX is the other. So what do they do on the hedge side when after they are long the Shanghai May contract? They could technically sell the May in TOCOM or sell the May contract in SGX. Of course, this is oversimplifying the whole process, but you get the idea. All right, the flows itself in the other markets will have an impact on our market. Now, when this happened, for example, and somebody started selling the, let's say the arbitrator started selling the May contract and SIMEX for their hedging purpose, it will put undue pressure on the May contract alone if that's what they choose to do. And if you move May without moving the other months, for example, the April and June, it will have an implication on the April-May and the May-June spread, obviously, and the April-June butterfly, April-May-June butterfly as well. And you can look at it in that manner and position yourself accordingly when you're looking at these other markets. Okay, and just to show you one of the questions that keep coming up during my past seminar. The ORA is SIMEX rubber, RTA is Shanghai, and SRBA is INE, and finally GNA is TOCOM. All right, these are correlationship coefficient between the various market. As you can see, some of them are pretty decent. Okay, now when I say decent, they do tend to move in a correlated manner. I do not necessarily mean for the average person or the average trader without the whole suite of physical capability to get into this trade, because other than timing different logistic issues and stuff, it is not exactly an easy trade to put on for most of us. Now, give you an example. For example, in TOCOM, as you know, TOCOM is actually very, very retail dominated, and there are only particular months, usually the 6th contract month or 5th or 6th contract month for the exchange that is actively trading. So unless you actually have a coincidental 4th month move on SIMEX that you can do something against, you probably will be better off just focusing on that single singular exchange that we are talking about tonight. Okay. Now, with that, I've come to the end of my presentation. This is my contact, my email, and my phone number. If you feel free, if you need to contact me. Otherwise, I'll just pass it back to Ming Hao for your Q&A.
All right, this is Sri from Flow Futures. Michael, can you hear me?
Yes, I can hear you loud and clear.
All right, great. All right. To the wonderful audience that we have tonight, if you have questions for Michael, just type them into the question box. In the meantime, Michael, I have some questions for you, which I believe some of the members of the audience would want to hear your views on. Let me run the first question by you. All right, term structure for rubber has been historically been in contango. Have you encountered any black swan event where the structure switched to backwardation? If yes, how do you manage the situation?
Okay. Now, there has indeed been, or I mean, even though rare, it has happened before. The most recent one was I was on the chart that I showed earlier, somewhere around the Q2 of 2019. Like I said, the catalyst for that move then was because of the US-China trade tension flaring up, and that was actually effectively wreaking havoc in everywhere and across all asset classes. Okay, now when that happened, traditionally when you have entered into a backwardation, right, your concerns are really the front month, the spot plus one perhaps. Okay, now you may not see it coming until it happened. Okay, but you will be able to feel it coming if you do not do it in isolation. That's why at the beginning I was saying, now from a trading perspective, right, a liquidity concern and obviously the fiscal complication or having to settle this in the delivery way, I would almost avoid trading the spot month up to a certain point. Now, for example, right now we're in the month of October. We just begin October, right? And the October contract just went off. So right now the spot month would obviously be November. Now, if I can help it, I would try not to dabble in November unless there's a substantial edge for me to be had. Okay, I would rather be looking at December onwards, for example. And like I said, the third to the fifth month are the most active contract, and that's where the most opportunity presents itself. So how I do it is, like, first of all, try not to get caught. That's one. Right? Secondly, I actually do a lot of different type of spread. What I introduced to you today is just a small part of my trading portfolio, and I actually do it in a lot of other ways that ensures that I'm properly hedged in regards of the whole suite of positions I'm holding. I hope that answers your question.
Yes, it has. Ready for question two, Michael?
Sure, go ahead.
All right, for rubber spread trading, how do you calculate the appropriate position size?
Okay, appropriate position size is really a function of your risk capital. It sounds a bit it really differs from individual to individual. Depends on appetite for risk, your ability to take on the position and whatnot. Now, as a general rule of thumb, for example, right, I allocated a certain amount of capital into rubber trading, and of this amount or this quantum of capital that I have availed for trading rubber, for example, I rarely commit more than 5% on any one position. And when I talk about position, I'm talking about spreads here. Okay, and typically for me, covering my basis is more important than just going for the big one, unless the condition presents itself in such a inviting way. Then obviously I'll be involved. But in any case, like I said before, my first and foremost concern is that of risk before profit. So yeah, and as a very, very general rule of thumb, for me, I usually will not have more than 5% committed in any one particular trade position. Okay, and that's on top of whatever else I'm doing.
Okay, we have a question from the member of the audience right now. His name is Satya. Firstly, he wants to say it's a great session. And his question is, with spread trading, do you not have to consider market views? If I have a view that the market is going to drop further, what would the trading what would the strategy rather be on spread trade?
Okay. Now, to answer that, let me start by saying something that I think I forgot to mention earlier. Now, the fact that we kept this recurring theme of stable term structure of this rubber spectrum, this is a fact because of the way the rubber demand and supply pattern is as it is today. Okay. Um, so when I'm doing it, I do consider the general direction of the market. It has a bearing on where the spread may or will likely end up, or at least it will actually help you make a better decision on your timing. Okay. So, but that is not my number one consideration. Like I said, if I were just solely, we talk about solely mean reversion strategy. My first point of consideration is, let's say if everything is as per usual, ceteris paribus, and then it hits my lower upper bound, then I want to enter a trade, and that is independent of where the current market is. Okay, the fact that the market moves just make this a lot frequent and a lot more faster than it otherwise would have been. Now imagine a market that's really dead and not moving and going neither way. Probably nothing much is going to happen outside of the regular flows. So my concern about where the direction is and whatnot actually applies to my other type of trading, but not so much in what we discussed today.
All right, next one, Michael. How
Yes.
frequent can you trade with this calendar spread strategy? Is it volatile enough for day trading?
Okay. For myself, speaking for myself anyway, I do this every day. Fact is, I did quite a bit today actually. Even though it's a China holiday and you expected the market to be relatively quiet, which it is, but in any case, there was still something going on in the market. And yes, it definitely can be done in a day trading manner. Although that's not the only time frame that I restrict myself to. Now, if you are doing this spread, know that because of the low risk nature, especially when you extend to the butterfly spread, for example, you got to be patient for the opportunity to present itself. And sometimes, because of the nature of that kind of spread, it may take longer to revert to a profitable level for you to exit. So I have a mix of day and longer than day trading, if that's what you're asking. So in general, if I have to put a point down, I would say probably about 1/3 of my trades are intraday, and a majority of it is longer than that period. Okay.
All right, so the next one is how many calendar spread pairs do you watch at any one time? Any preference for any spread? For instance, 1 month spread or 2 month spread?
Okay. They 1 and 2 month spread, they each have their own individual character. They behave, to me anyway, they behave slightly differently. Okay. I don't trade it in isolation. Like I explained the synthetic earlier, the purpose of me explaining it is I want you to understand the markets are all correlated. The prices are basically derived from the individual contract months, so they have to be correlated. So in that sense, I don't actually have a favorite. Although I can tell you of experience, the 1 month spread, generally speaking, are a lot more liquid than the 2 months. But the 2 months, if you get it right, will offer a lot more reward, of course, with the consuming increase in risk as well. Okay, and likewise, what I explained the butterfly spread earlier. Usually, I would say like I said, the 3 to 6 months combination type of spread is where I would do most of my trade. Well, it's out of necessity because liquidity is most concentrated in that band of the spectrum. So a lot of flows, the buyer, seller, and all are concentrated around those expiration, and therefore the opportunities are also presented in that area of the calendar spectrum. So that's what I do.
All right, so the next one is very important for traders. How do you know when to cut loss? Should you add on positions to average your position?
Okay. Good question, actually. I did not fully explain it earlier. Now, but when I did say that we go about this structurally and doing all the legworks, I make it a bit simple when I draw two lines across and tell you this is upper and lower bound visually. I don't do it this way. but this is roughly in the spirit of what I do. Okay, I use a few mathematical models to derive at what I deem to be the statistical significant level of entrance and exit. Usually, this is somewhere between 2 to 2.5 sigma from mean, long-term mean, if you don't mind. And I'm not looking at it across 1 year, for example. What I meant by 1 year is like, for example, currently we are in the year 20, and the current spot month is January, for example. When I'm looking at January 21 versus February 21 spread, I'm also looking at the past January 20 versus February 20, the Jan 19 versus the Feb 19. This is so that I get a sense of what has happened before, what can happen. So now when you have established those bottom lines, for example, you know with a certain degree of confidence that it's unlikely, let's say, for example, it's unlikely to move 10 points away from the mean, so plus minus 10, for example. Now, if you're trading it when it's nearing, I imagine if it's minus 9 or 8 from the mean, you'll probably be starting to go in and to turn long in this particular spread. Now, what happens if it goes to 15? Would you get out? That depends on what your studies show you. Okay, let's say historically it has never gone to a certain point before, and it also has to tie down with your risk management preference. For example, how much are you willing to risk in this particular trade versus what is potentially possible? Okay, after all this consideration, then you can objectively say, no, this is the point I need to get up. Okay, but for most of us, it's a simple way of looking at our risk management preferences. For example, if you're only going for 5 ticks, why would you want to risk 10? That doesn't make sense at all, correct? So at the very best or at the very worst, you should do no worse than 5 from your entry, in a sense from where the level you establish. I hope that answers your question.
All right, Michael, the next one is, when you're executing the trade, do you hit the spread or do you do it separately by legging? What situations call for which method to be more appropriate? Michael.
Okay, sure. Well, there are different segments of the same market. Okay, like I explained earlier about synthetics, the market don't necessarily move all in tandem, or at least not in precise unison. So what I meant is this: say for example, the earlier example of somebody doing a bit of a dumping in Shanghai, let's say the May contract, for example, and the arbitrageurs went in and take the opposite long side in Shanghai, and he's looking for a hedge to sell. So he sells TOCOM, he sells Simex, and the easiest or the most straightforward for him to do a hedge is to sell the May contract, for example. Now, when he's doing that, depending on how far and how fast he's getting hit on Shanghai, he also needs to do quickly on his hedge leg so that he doesn't miss or minimize his slippage, so to speak. So when he's doing that, let's say if he's doing that in particular to May contract in Simex, okay, it moves the May by a lot more than the April and the June will move at that point of time. So essentially, he's moving the outright market, okay? The outright April and June has not moved. Neither has the calendar, because the interest at that point is not in the calendar, but it was rather in the outright. But for me, it's like that. If the May moves so much that it's actually off where the imply of the synthetic is, what I will do is I will buy a April, for example. I'll buy the May, since he's dumped it down, and I'll sell either the April or the June, while I was looking at the April, May, or the May, June listed calendar spread. Say, for example, if it's listed at 10, and I could do this for, let's say, at 9 points, rather 11 points. In this case, I go long 11 points, for example, I'll do it. Or the other way around, if it's actually buying up. So that's where I'm coming from. I don't actually have a preference of doing one way or the other. It really boils down to efficiency of execution and what the flow dictates. Okay.
All right, Michael, the last question for the day is, can we apply this same strategy to all futures products? Michael.
To all futures. Okay, sorry, excuse me. What we talk and share about tonight is very specifically SGX rubber futures, calendar futures spread. why I keep mentioning this is because when I talk about mean reversion strategy, I'm confident enough to tell you about the term structure and the mean reversion properties of this particular calendar spread. So I'm actually banging on the premise to hold steady, or the relationship to hold true. Therefore, I can execute and implement this trade. Okay. Now, different futures may have different kind of risk characteristic VOF profile that may be entirely different from rubber trading, or SGX rubber to be specific. Now, even know this, even the rubber in Shanghai and Tokyo, right, trades quite differently when compared to SGX. I said they are related, but on an intraday basis, when you're actively trading it, actually is a different beast altogether. Okay, so in that sense, I would say in the most general way, probably not, but the approach would be the same. If you have find something, or you found something to be exhibiting this kind of mean reversion property, and the mean reversion strategy would definitely work very well. Okay.
All right. Thank you so much, Michael, for a wonderful and insightful session.
Most welcome.
And thank you for being a wonderful audience. Dear audience, the conversation doesn't have to end here. If you have questions for us, you have questions for Michael, you can type them down in the survey questionnaire right after this webinar, and we'll be pleased to address them after. If you're looking for the link to exploring SGX robot trading opportunities part 1, I've left it in the chat box, which you can find on your control panel. Just click into the chat function and pick up the link from there. I've also added another link to our upcoming strategy webinars, just like this one. We believe you will enjoy it as well. You just click on the link and sign up for our upcoming strategy webinars. And any other questions, just type in your question box. Even if you have questions about opening an account, or whether we have the TT platform that Michael was talking about earlier, or what are the key questions that you may have as a trader that you have for Philip Futures. Just type them away in the question box, in the survey form rather, and we'll get in touch with you. Thank you for being a wonderful audience. If you have any other
Thank you very
questions,
much, guys.
thank you, Michael. Have a good night.
You too, man. Take care.
Thank you,
Bye.
everybody. Bye bye.